Hello, everyone, and welcome back to Synaptic Investing.
Hello, everybody.
I hope you're having a fantastic week and are ready for another deep dive. Today is February 14th, 2026, so happy Valentine's Day to those of you celebrating.
Indeed.
And we are going to look at a relationship that a lot of investors are, well, completely obsessed with right now. And frankly, it might be the most complicated romance on Wall Street.
That's a good way to put it.
Today, we're breaking down one of the most interesting and, I think, misunderstood companies on the market. Yeah. The refining giant Valero Energy Corporation.
VLO.
That's the one. If you're looking at your screen, you'll see it trading near its 52-week highs, sitting right around, what, $198?
Yeah.
It's a massive, complex machine. And, on the surface, it looks like an absolute fortress of a company.
It really does. It looks invincible.
But the real question for us as long-term investors is this. Are there hidden cracks in that fortress that the market is ignoring? That's what we're here to find out. Specifically, we have to ask, are we looking at a permanent golden age of refining? Or is this the classic investor trap? The one where you buy a cyclical stock at the exact peak of its cycle?
Right at the top.
That is what we have to determine today.
That's a huge topic, and honestly, the answer is terrifyingly complex. Before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business model.
Let's start at the very bottom, because I think a lot of people hear energy company or oil company, and they lump everything together.
Oh, absolutely.
They think Valero is out there in the Permian Basin with a hard hat, drilling holes in the ground like in the movie, There Will Be Blood.
Right. I'd drink your milkshake.
Exactly.
Yeah.
But that isn't Valero, is it? We need to be crystal clear about what they actually do.
No, not at all. And if you want to understand the stock, this is the first thing you have to get. You have to completely separate the idea of Valero from the upstream companies.
Like Exxon or Chevron.
Exactly. The ones who do the actual drilling. Valero is a pure play downstream operator. They are a refiner. They don't look for oil. They process it.
So no drilling rigs, no exploration teams gallivanting across the globe.
0 rigs. Think of Valero's business model as a massive industrial black box. It's really a manufacturing operation, not an exploration one.
Okay.
On the left side of the box, you have the raw input, crude oil. On the right side of the box, you have the finished output, refined products like gasoline, diesel, jet fuel, and petrochemicals.
And Valero just sits in the middle.
Valero sits in the middle. They are the machine that cooks the raw ingredients into the meal you buy at the store.
So their profitability isn't strictly about oil prices going up as good. In fact, high oil prices might actually be bad for them if they can't pass those costs along to the customer.
Precisely. And this is where most retail investors get completely tripped up. Valero's business model is based on the spread.
The spread.
They make money on the difference between the price of the raw ingredient, the crude oil, and the price of the finished product, the gasoline. We call this the crack spread.
Okay, let's unpack crack spread.
Yeah.
I know it sounds like something illegal or maybe a plumber's problem.
It does.
But it's the industry standard metric. So how is that actually calculated? Because this one number basically dictates whether the stock goes up or down.
It really does. It refers to cracking the long hydrocarbon chains in the oil into smaller, more valuable ones. The industry standard calculation is the 3-2-1 crack spread.
3-2-1.
It's a theoretical approximation of a refinery's margin. Imagine you buy 3 barrels of crude oil, you process them through the system. The yield of the output is typically 2 barrels of gasoline and 1 barrel of distillate.
Distillate being like diesel or heating oil.
Exactly. So 3 inputs equals 2 gas plus 1 diesel.
Got it.
So the math is simple. You take the price of those 2 barrels of gasoline, add the price of that 1 barrel of diesel, and then you subtract the price of the 3 barrels of crude you started with.
And whatever is left over.
That remaining number is the gross margin for the refiner. That is the money they have left over to pay for the plant, the employees, the electricity, and hopefully, the dividend for shareholders.
And that is the number that dictates their life.
Yeah.
It's the absolute heartbeat of the company.
It is the heartbeat. And here is where the story gets fascinating for where we sit today, in February 2026.
Right.
If we look back at the supercycle between, say, 2022 and 2024, those spreads They were just astronomical.
Oh, I remember.
We were seeing $30, sometimes $40 per barrel in margins. It was a license to print money.
What was driving that?
It was a perfect storm for refiners. You had supply chains that were still broken from the pandemic. You had Russia being sanctioned, which took a lot of product off the market. And you had demand roaring back.
I remember that vividly. Those were the days when gas prices were just skyrocketing. Politicians were on TV yelling about price gouging. And Valero's stock chart basically went vertical.
But where are we today? We're in Q1 2026. Is that party still raging?
The party is definitely winding down. The lights are coming on. The music has stopped. And the cleanup crew is here.
Oof.
The Gulf Coast 3-2-1 crack spreads have normalized, and I mean significantly. In the fourth quarter of 2025, we saw them average around $13 to $15 per barrel.
13 to 15. Wow, that is a massive drop from over $30 down to, let's call it 14. That's more than a 50% haircut on their gross margins.
It is.
That is not a small adjustment. That is a fundamental shift in the profitability of the entire industry.
Exactly. We are back to a more historical and I would say sustainable reality. And this brings up the critical issue of pricing power. This is what scares me about this business model. If my margins drop by 50%, can I just raise my prices? Can Valero call up the gas stations and say, hey, we need an extra $5 a barrel to meet our quarterly targets?
Short answer.
No.
Not at all. It's not a chance. They have zero pricing power. This is absolutely crucial for any listener to understand. Valero is a price taker, not a price maker.
Okay.
They are squeezed between two massive global commodity markets. They cannot dictate the price of crude oil. OPEC and the global market decide that.
Right.
And they cannot dictate the price at the pump. Global demand and competition decide that. They are purely a processor caught in the middle.
That sounds like a terrifying business model. You have huge capital expenses, incredibly dangerous operations, and you can't even set your own prices.
It is.
Why would anyone want to be in this business? It feels like you're just gambling on macroeconomics.
It does sound scary, and it is an incredibly tough business. But there is nuance here. Their power doesn't come from setting prices.
Okay, where does it come from?
It comes from flexibility. This is their secret sauce. This leads us to the concept of feedstock advantage.
Feedstock meaning the crude oil they buy, the input.
Right, exactly, the raw material. And not all crude oil is created equal. You have light sweet crude, which is like the champagne of oil.
For good stuff.
It's low in sulfur, it's thin, it's very easy to refine. That's what comes out of places like the Permian Basin in Texas. It's expensive because everyone wants it, and it's easy to work with.
Okay, so that's the premium stuff. What's the alternative?
Then you have heavy sour crude. This is the nasty stuff. It's thick like molasses or tar. It smells like rotten eggs because of the high sulfur content.
Right.
This comes from Canada, Mexico, Venezuela.
So it's basically garbage crude.
It is garbage crude, and because it is garbage, nobody really wants it, so it trades at a massive discount to the light sweet crude.
So the garbage is cheap. I think I see where this is going.
Valero has spent billions and billions of dollars over decades building refineries that are specifically designed to chew up this garbage crude. They invested in the complex hardware when everyone else was chasing the easy stuff.
So while a simple, basic refinery has to buy the expensive champagne crude to make gasoline,
They have no choice.
Valero can buy the cheap garbage crude. But, and here's the magic, once it goes through Valero's complex machinery, the output is identical.
Exactly. A gallon of gas made from garbage crude sells for the exact same price as a gallon of gas made from champagne crude. Your car's engine does not know the difference.
So if the champagne crude costs $80 and the garbage crude costs $60, but they both turn into $100 worth of gasoline, Valero is pocketing that extra $20 advantage just because their stomach is strong enough to digest the bad food.
That is the perfect analogy. That $20 differential, that is their structural advantage. It's why they consistently outperform their peers. But even with that advantage, we have to acknowledge that the macro environment has shifted. The tide is going out on everyone.
Which brings us to the economics of the stock itself. You know, we often talk about old economy versus new economy. We cover a lot of tech stocks here, and we're used to seeing companies that lose money but grow at 40%. Valero is the complete opposite.
It is the anti-tech stock. It's an entirely different animal. This is a clean cash flow story. One thing investors love here is the lack of dilution.
Right.
In the tech world, you're constantly dealing with stock-based compensation, SBC. You buy a share of, say, Palantir or Snowflake, and the employees are getting paid in millions of new shares, which dilutes your ownership stake.
Right, you own a smaller and smaller piece of the pie every single year because they just keep printing more shares to pay the engineers.
With Valero, SBC is less than 2% of their expenses. It's a rounding error. It's basically nothing.
So their earnings are real.
When Valero reports net income, it's real. When they report free cash flow, it is real distributable cash. Historically, over 80% of their net income converts directly to free cash flow.
That is a staggering number. It means the earnings are incredibly high quality. They aren't accounting tricks or some adjusted EBITDA nonsense. It's just cold, hard cash in the bank.
Exactly. It passes our quality of earnings test with flying colors. But, knowing the earnings are real is only step one.
Right.
Step two is asking, is the business defensible? Can someone else come and eat their lunch? Which leads us to pillar 2, the moat.
Okay, let's talk moats. We love using the Hamilton-Helmer framework here. What makes Valero different? Why can't I just go build a refinery in my backyard and start competing with them? Aside from my homeowners association having a complete fit about the smell.
Well, aside from the HOA and the zoning laws, you have two massive barriers. The first is just sheer scale economies and complexity.
Okay.
Valero isn't just a big player. They are a leviathan. They own 15 refineries with a throughput capacity of roughly 3.2 million barrels per day.
3.2 million barrels every single day.
Yeah.
The logistics of that alone are just mind-boggling.
It's a mess.
Moving that much liquid, heating it, cooling it, storing it.
It is, but the scale is only part of it. The real moat is that Nelson Complexity Index we hinted at earlier.
Break that down for us. What is the Nelson Complexity Index? Is it like a credit score for refineries?
That's actually a pretty good way to think about it. It's a scoring system that rates the secondary conversion capacity of a petroleum refinery.
Distinct air conversion.
So a basic refinery, which is basically a giant tea kettle that just boils oil to separate it, might have a score of 1 or 2. It separates the oil by weight, but it can't really change the molecules. It just sorts them.
Okay, so that's the basic, simple model.
Valero's refineries have scores of 12, 13, 14. They are essentially massive chemical laboratories. They have cokers, hydrocrackers, alkylation units.
These sound like villains in a superhero movie. Beware, the hydrocracker.
They might as well be. They are massive, multi-billion-dollar units that literally break apart heavy molecular bonds. They take the thick, tar-like molecules and crack them into lighter, much more valuable molecules like gasoline.
And to build one of those today.
To replicate Valero's entire asset base today, to build these 15 complex refineries from scratch, would cost tens of billions of dollars, maybe $100 billion. And it would take decades.
And that leads me to the anti-moat idea. You mentioned decades. Is anyone actually building new refineries? I feel like I haven't heard of a new refinery opening in the U.S. in my entire lifetime.
That's because, effectively, you haven't. There haven't been any major greenfield refineries built in the United States since the 1970s.
Since the 70s. That is half a century.
Yes. In the United States, the regulatory barriers create a massive protective wall around the incumbents, like Valero.
So the EPA, local permitting.
The not in my backyard or NMBY movement, the immense capital costs. No one is building a new major refinery in America. It is practically illegal.
So paradoxically, the strict environmental regulations that we hear so much about actually help Valero.
They absolutely do.
Because they stop new competitors from ever entering the market. It freezes the competition in place.
Exactly. It's a very powerful regulatory moat. But, and this is a huge but, we have to look globally. Oil is a global game.
Right.
A barrel of diesel can move from Texas to Rotterdam or from Shanghai to Los Angeles in a matter of weeks.
What about the rest of the world? Are they building refineries, or is the whole world stopping?
That is where the anti-moat challenge comes in, and I'm glad you brought that up because this is the core of the bear case against them.
Okay.
While the U.S. is completely stagnant on capacity, the Middle East and Asia are building like crazy. We are seeing massive state-of-the-art refineries coming online in places like China, India, Kuwait, and Saudi Arabia.
And these aren't the simple tea kettles you mentioned earlier.
No, these are monsters. They are state-of-the-art, high complexity, and they're positioned right next to the growing demand centers in Asia. These new refineries are flooding the global market with diesel and gasoline. This puts immense pressure on Valero's export margins. So while Valero is relatively safe at home in the U.S. domestic market, their ability to export product at a high margin is under siege.
So it's a fortress in America, But the walls are being tested internationally.
Constantly.
If you can't control the price and new, very efficient competitors are popping up overseas, what do you do? How do you even survive that?
You focus on what you can control. In the Hamilton-Helmer framework, we call this process power.
Process power.
Think of it as the Toyota way, the Toyota production system, but applied to a refinery.
So continuous improvement, operational excellence, squeezing every last penny out of the operation.
Exactly. It's boring, but it's absolutely vital. Valero consistently runs at utilization rates over 95%. They beat their peers on this metric constantly, year after year.
Why is 95% so hard? Why not 100%?
Because things break. These are harsh environments. You have extreme temperatures, extreme pressures. Pipes corrode, valves get stuck, compressors fail.
Right.
Running a refinery at 95% capacity requires rigorous predictive maintenance, precise logistics, and a culture of absolute perfection. In a commodity business where you sell a generic product, being the low-cost producer is the only survival strategy.
The only one.
You survive the down cycles by being more efficient than the guy next to you. If the market price for gasoline drops to $10 and your all-in cost is $8, you survive. If your competitor's cost is $11, they go bankrupt.
So Valero is the cockroach that survives the nuclear winter because they are just better at being a cockroach.
That's one way to put it, yes.
Exactly.
I'd probably say they are the elite athlete of efficiency, but cockroach works too.
And that efficiency, that mindset, it seems to stem directly from their internal culture. Let's talk about that. Pillar 3, soft power. We looked at some inside view data from Glassdoor, internal reports, and industry forums. How would you describe the vibe inside Valero?
The best way to describe it is a military operation.
Ooh, that sounds intense.
It is, and it absolutely should be. The data shows a culture that is highly disciplined, obsessed with safety, and strictly hierarchical. Now, if you were working at a creative ad agency or a tech startup, this would sound suffocating.
Yeah, I was going to say, you'd hate it.
Right. No beanbag chairs, no work from anywhere policies, no ping pong tables in the break room.
Definitely not.
Yeah.
But you have to understand the context. In refining, a mistake isn't a bug in the code. You don't just push a software patch on Monday morning to fix it.
Yeah.
A mistake is an explosion. A mistake is a massive oil spill. A mistake kills people.
That puts it in perspective. You don't want a move fast and break things culture when you're dealing with millions of barrels of explosive liquid at 900 degrees.
Exactly. They don't need creativity in their day-to-day operations. They need high reliability. They need people who follow the checklist every single time, without question, without deviation. And that culture flows all the way up to management as well. So let's talk about the C-suite. We often reference the book The Outsiders by William Thorndike. It talks about CEOs who excel at capital allocation, how they spend the company's money. Does Valero's management fit that mold?
They absolutely do. They are classic outsiders. Management here isn't interested in empire building. You don't see them making splashy, ego-driven acquisitions of overpriced companies just to get bigger or to get on the cover of Forbes magazine.
No vanity project.
None. They are ruthlessly focused on one thing: return on invested capital, or ROIC.
Which is a perfect transition to our next pillar, financial resilience and capital allocation. We've established the business is tough, but management is disciplined. Let's look at the numbers as they stand today, February 2026.
Let's start with the quality of earnings again, but look at the trend. We mentioned earlier that margins are normalizing or compressing. To be specific, their operating margins have compressed to about 5.2% in the fourth quarter of 2025.
5.2%. That sounds incredibly thin, especially compared to the software companies we sometimes discuss that have 80% gross margins.
It is thin, but it's actually pretty typical for a mid-cycle refiner. The more concerning number, for me at least, is the ROIC, that return on invested capital we just mentioned. It's currently sitting at roughly 10.2%.
Okay, for the listeners who don't have an MBA, why does that 10.2% number matter so much? Is that good? Bad?
It's neither good nor bad in a vacuum. You have to compare it to the cost of getting that money in the first place, the WACC, or the weighted average cost of capital.
Which is?
It's the blended rate of the interest on their debt plus the expected return of their shareholders. Valero's WACC is estimated to be around 9.7%.
Whoa, wait a second. So they are making a 10.2% return, but it costs them 9.7% to get that capital.
Correct.
That is cutting it incredibly close. They are barely creating any value.
They are creating value, but barely. The spread between their return and their cost is tiny, about 0.5% or 50 basis points.
I mean, how does that compare to the good times?
Contrast that with the super cycle of 2022-2023, where their ROIC exceeded 25%. Back then, the spread was massive. Now that spread has tightened dramatically. This is the normalization we keep talking about. The easy money is gone.
So if the business isn't generating those massive returns anymore, and they are barely covering their cost of capital, why are investors still holding the stock? Why is it trading at $198?
Because of what management does with the cash they do generate, we call Valero a Tier 1 cannibal.
I love that term. It sounds so aggressive.
It is aggressive. A cannibal is a company that relentlessly eats itself. It buys back its own stock. Valero has reduced its share count by roughly 30% over the last decade.
30%. That is a huge number. That means if I held one share 10 years ago, my ownership stake in the company has effectively increased by nearly a third without me spending another dime.
Precisely. Imagine a pizza that's cut into 10 slices. You own one slice. Valero uses its cash to buy back 3 of those slices and just throws them away.
So they disappear.
Now, the pizza is only 7 slices, but your one slice represents a much larger percentage of the whole pie.
So even if the pizza itself isn't getting any bigger, even if the company's total profits aren't growing, my slice is getting more valuable.
Exactly. Even if profits are totally flat, earnings per share, or EPS, can go up simply because the denominator, the number of shares, is shrinking. It is a powerful way to engineer growth in a stagnant or cyclical industry.
But buybacks are only a good use of capital if the stock is cheap, right? If they're buying back stock at $200 and the stock is really only worth $100, aren't they just lighting shareholder money on fire?
That is the risk. And that is the primary criticism right now. Buying back stock at all-time highs is questionable capital allocation. But management would argue they have no better place to put the money.
Because they can't build new refineries.
Can't build new ones, and they don't want to overpay for an acquisition, so they return it to shareholders. And they didn't forget about the dividend investors either.
No, they did not.
Not at all. They recently hiked the dividend by 6%. It's now $1.20 per quarter, which is $4.80 annualized. And because they are so disciplined with CapEx spending, only about $2 billion a year, mostly on maintenance, that dividend is well covered, even in this tighter margin environment.
Okay, so we have a cash machine that is buying itself back and paying us to wait. But you can't just cut your way to greatness forever. Eventually you need actual growth. But oil is, well, it's oil. People say it's a dying industry. Where's the growth going to come from?
This is where Valero gets really, really interesting. They are engaging in what we would call counterpositioning. While everyone else was wringing their hands and debating the future of oil, Valero quietly went out and became the world's second largest producer of renewable diesel.
This is the Diamond Green Diesel Project, the DGD joint venture.
Correct. This is their joint venture with a company called Darling Ingredients, and it is an absolute beast. Now, we need to clarify something very important here. Renewable diesel is not biodiesel.
What's the difference? I honestly thought they were just synonyms for corn fuel or something.
That is a very common misconception. Not at all. Biodiesel is made by mixing fats and oils with alcohol. The chemical process creates something called an ester. It has problems. It gels in the cold. It can separate from petroleum diesel, and engines need modifications to run high blends of it.
Okay.
Renewable diesel is made by hydrotreating fats, using hydrogen to remove the oxygen.
Hydrotreating. That sounds like what they do in the regular refinery with crude oil.
Exactly. That's why Valero is so good at it. They just applied their core refining expertise to a new feedstock. The result is a molecule that is chemically identical to petroleum diesel. It's a drop-in fuel.
Amazing.
You can drop it straight into a truck engine, 100% pure, without modifying a single thing. It doesn't freeze in the winter. It burns cleaner. It's a superior product.
And why is this so strategic? Is it just PR greenwashing so they can put a little leaf on their logo and feel good?
No, this is a real business. This segment generates over $1 billion in EBITDA. First, it hedges them against long-term oil demand destruction. If oil demand eventually drops, renewable demand will likely rise due to regulations. Second, the margins here are less correlated to the price of crude oil. They benefit from powerful regulatory tailwinds like the Low Carbon Fuel Standard or LCFS credits in California.
So California is basically paying them extra to sell this fuel there.
A lot extra. It's a subsidy-driven market, which is definitely a risk we'll talk about later, but for now, it's a cash cow.
And I've heard a lot about sustainable aviation fuel, or SIF.
Yeah.
Is that part of this same story?
That is the new frontier for them. Think about it. We have electric cars. We might eventually have electric semi-trucks, though the physics on that is still debatable. but electric airplanes.
A 747 with a giant battery. It doesn't seem plausible.
It's a physics problem we haven't solved. Batteries are incredibly heavy for the energy they store. Jet fuel is unbelievably energy dense. If you put enough batteries on a plane to fly across the Atlantic, the plane would be too heavy to take off.
So for the foreseeable future,
If the aviation industry wants to decarbonize, they need a liquid fuel. SAF is the only game in town.
so let me see if I get this. The total addressable market, or TAM, for traditional gasoline is in secular decline because of EVs.
Correct. It's a shrinking pie.
So Valero is fighting for a bigger slice of that shrinking pie with their efficiency, while simultaneously building a dominant position in the growing pie of renewable fuels and SF.
That is a brilliant way to summarize it. They're using the cash from the dying business oil refining to fund a dominant position in the future business, which is renewables.
Okay, this all sounds great. Best-in-class operator, smart pivot into renewables, aggressive cannibal buybacks. But now we have to talk about the massive elephant in the room, the price.
Pillar 6, the valuation. This is where the rubber meets the road.
We are looking at a forward PE for 2026 of roughly 19.1 times. The stock is at $198. Historically, Valero trades at what, 12 to 15 times earnings?
Yes, historically, 12 to 15 times has been the ceiling, not the floor. We are currently trading at a significant premium to its own history and to the sector median.
So, to justify paying $200 for this stock right now, what do I have to believe? What is the market pricing in?
You have to believe in the soft landing wager. That's what the market is betting on. To justify this price, you have to believe two very important things.
Okay, what's the first one?
One, that the global economy avoids a recession completely, a perfect soft landing. If we hit a hard recession, demand for diesel and jet fuel drops off a cliff and those crack spreads collapse.
And the second belief?
Two, you have to believe that crack spreads have found a new permanent floor that is significantly higher than the historical averages. The market is betting that $18 to $20 per barrel spreads are the new normal forever.
The market believes the golden age of refining is here to stay.
That's the bet. Correct. But let's stress test that. Let's look at the math. If we try to triangulate the intrinsic value, the picture gets cloudy.
Walk us through the methods. Let's start with the bearish view.
Method A, historical mean reversion. This is the classic bear case. If Valero simply reverts to its historical average PE of 12 times, and it hits the consensus analyst EPS of around $10.45 for 2026,
Yeah.
the stock is worth roughly $125.
Ouch. That is a long, long way down from 198. That's a 37% drop.
It is. Now, method B is the analyst consensus. The street is generally bullish on the company. The average price target is $195.
Wait, but the current price is already higher than the average analyst target?
Exactly. So even the bulls on Wall Street are effectively saying it's fully valued. There is no upside left according to the consensus. And method C, owner earnings, or free cash flow yield. If we assume a normalized free cash flow of, say, $12 per share, and we demand an 8% yield, which you should for a zero-growth cyclical stock,
Right.
you get a value of roughly $150.
So we have a bear case of 125, a consensus case of 195, and a cash flow case of 150. And the stock is trading today at 198.
Right. The verdict is pretty clear from our perspective. At $200, there is zero margin of safety.
Done.
You are paying a premium price for a cyclical asset at what looks like the top of its earnings cycle. You are buying a winter coat in July at full retail price.
This brings us to the red team argument. We always like to invert the story. If I wanted to completely destroy the bull case for Valero, what would I say?
The red team argument here is incredibly strong and very simple. It goes like this. You are buying a cyclical stock at the top of its cycle and at the top of its price chart.
The dreaded double top.
Yes. There is a standard rule in cyclical investing. You buy cyclical stocks when their PE is high.
Right, that sounds completely backward. You buy when the PE is high. Usually we want a low PE.
In normal, stable growth stocks, yes. But in deep cyclicals like oil, steel, or mining, a high PE usually means that earnings have completely crashed. They are at the trough of the cycle.
Okay, so the E in PE is tiny, making the ratio huge.
Exactly. And that's when the cycle is about to turn up. Conversely, you sell when the PE is low because that means earnings are at a peak and are about to roll over and fall.
Okay, so usually high PE equals a good entry point because earnings are about to recover. But what's happening now?
But here, with Valero, we have a very strange anomaly. The PE is high 19 times forward, and the price is high, near $200.
So we have the worst of both worlds.
This suggests the market has completely decoupled the stock price from the underlying deterioration in the business fundamentals. Crack spreads have dropped 50%, earnings are falling, but the stock price is staying up.
That sounds like Wile E. Coyote when he's run off the cliff, but he hasn't looked down yet.
That is the fear. That is the perfect analogy. You are effectively betting that the business cycle has been abolished, and history tells us that the business cycle always wins in the end.
So let's do a pre-mortem. This is our next pillar, risks. Let's say we buy the stock today, and in 3 years, we've lost 50% of our money. How did it happen? What went wrong?
The first and most likely killer is demand destruction via electric vehicles. We all see the Teslas on the road, but the math is brutal for refiners.
How so?
Refining is a high fixed cost business. You need massive volume to cover the cost of the plant. If U.S. gasoline demand drops just 2% annually, which is actually faster than current projections, but very plausible given EV adoption rates, Gulf Coast crack spreads could completely collapse.
Not just to $13 like now.
No, not to 13, but to single digits, maybe $8 per barrel.
And if spreads hit $8.
Valero's earnings power drops to maybe $5 per share. You put a normal cyclical 10x multiple on that, and you have a $50 stock. That is the disaster scenario.
And what about the regulatory risk? We mentioned that Diamond Green Diesel relies on government credits.
That's the stroke of the pen risk. That's the second killer. If a new administration comes in from either party and decides to remove the renewable fuel standard, the RFS, or kill the blender's tax credit because they think it's a waste of money,
Yeah.
the profitability of the Diamond Green Diesel segment evaporates overnight. That whole beautiful growth engine we talked about, gone. Wiped out by a single piece of legislation.
So let's zoom out. Let's move to our final pillar, the future outlook. Looking to your crystal ball, it's 2031, 5 years from now. What does Valero look like as a company and an investment?
I see Valero transforming into a cash cow in decline. I think the days of it being a growth stock are over. It will function much more like a high-yield annuity or a bond proxy.
Meaning what exactly?
Meaning the stock price itself might be flat. Maybe it's trading at $180 in 2031, which is basically where it is now. But over those 5 years, it has paid you $60 in dividends.
So your entire return isn't from capital appreciation. It's from the income, from the dividend checks.
Exactly. And we have to expect a valuation derating over that time. As electric vehicles gain more and more market share, investors are going to be less and less willing to pay a high multiple for a gasoline refiner.
It becomes a value trap story.
They won't pay 19 times earnings. They might only be willing to pay 8 or 10 times. The PE multiple will likely compress as those terminal value concerns grow louder and louder.
It becomes a melting ice cube. But I guess a melting ice cube can still be refreshing if you drink the water as it melts.
That's a great way to put it. You can still make money, but you have to know what you own. You aren't owning the next NVIDIA. You are owning a well-run machine that is slowly and rationally managing its own decline.
All right, let's wrap this all up with our synthesis. We give 2 scores here. 1 for the quality of the business and 1 for the valuation of the stock.
For quality, I'm giving Valero an A-. This is a best-in-class operator. They are the Cannibal of capital allocation. They have the best, most complex refineries. They are a clear leader in renewables. If you absolutely have to own a refiner, this is the one you own.
A- on quality. Pretty high marks. And on valuation.
I have to give it a D. It is priced for perfection. Paying 19 times forward earnings for a deep cyclical company when its core margins are compressing is just dangerous. The risk-reward skew is firmly to the downside at this price.
So let's put it all together. The thesis summary.
The bull case is this. We are in refining supercycle 2.0. Global capacity constraints keep margins elevated at $20 plus forever. Renewable diesel explodes in popularity, and the aggressive buybacks keep EPS growing even if the business doesn't.
And the bear case.
The bear case is that mean reversion hits, and it hits hard. Margins go back to their historical average of $12. EPS falls to $6 or $7, and you realize you walked right into a classic valuation trap, paying 19 times earnings at the absolute peak.
And the final provocative thought to leave our listeners with.
We often talk about EVs as some far-off future threat. Oh, in 2035, things will really change. But I want you to consider this. What if 2026 and 2027 is the tipping point?
The inflection point.
What if this is the year where EV fleet share fundamentally shifts from early adopters to the mass market? If we are crossing the chasm right now, today, are we looking at the last great high watermark for fossil fuel valuations?
That is a chilling thought. If this is the peak of the mountain, the only way is down.
If so, even a great company like Valero is a melting ice cube, and you're buying it when it's already half melted.
On that cheerful note, thank you all for tuning into this deep dive on Valero. It's a fascinating company, a complex machine, and a very, very tricky stock.
Absolutely. Do your own diligence, and for goodness sakes, watch those crack spreads.
Don't forget to check out the link for Interactive Brokers in the description, hit that like button, and keep your synapses firing. We'll see you in the next one.
Goodbye, everyone.